This week we're going to have a look at the Italian premium car manufacturer known as Ferrari. They need no introduction, they are very well known everywhere. They are very well known for their fast and premium level cars. They officially did their IPO in 2015, so the majority of the data is actually from that time. Now, of course, there are some revenue and financial statements from prior to that time, but by and large, we will be looking at 2015 onwards. Just to head right on in, having a look at their revenue, what we can see here is in 2014 they booked 2.7 billion in revenue, which has increased all the way to 4.2 billion. Now, these are not quite in line with the big numbers that we've been looking at previously, like with Louis Vuitton or with Unilever, because Ferrari is actually a relatively small scale company. They do not produce in large quantities. They produce small quantities but very high premium, very high quality cars, and that's why their revenue and earnings relative to those other bigger companies are quite low here. But nevertheless, what we see is a revenue growth on year over year of about 6.4%, which is very much what we like to see. They are increasing their output in cars. They are increasing their price. They are maintaining the quality that they're very much known for, and they are keeping steady when it comes to that. Looking at earnings, we can see they start off with 3.8 billion and moved all the way up to the very first billion in earnings in 2021. Which is an increase of 15.6%. Now these are pretty high numbers for a car manufacturer that is as long and established as Ferrari is. And what we can see here as well is that the margins between their revenue and their earnings have been growing drastically, which means they are becoming a lot more efficient in running their business. They are able to reduce the cost, which can drive their earnings. So by and large, it's a very good opening for Ferrari here. Looking at their debt level, we can see that it's risen from almost half a billion to 2.6 billion here in 2021, which is a relatively big increase, but then again, so has their earnings, so I think it's completely fair for them to lever up a little bit, although I do think it's towards a scary area here. But most of the risk, I think, is cancelled out by the fact that they do have much excess cash on hand here. So if they want, they can actually pay off half of their debt whenever they feel like it. So I think that kind of cushions the blow when it comes to the downside risk. Market cap has been increasing ever since their IPO in 2015. They had an annual compounding annual growth rate in their market cap. So in the share appreciation as seen on the stock market itself, they've been growing on average 36.7% year over year. That is insane return for any investor, and any investor who got the IPO of Ferrari in 2015 and have just sat on their shares for the past 7-6 years, they would have made absolute bank. Enterprise value is the market cap to which we add the debt and subtract the cash. Now, because in relative terms there's not that much to speak about. Oh, sorry, this is a bit of an anomaly there. Because in relative terms there's not that much to speak about. Actually, what we'll probably see is that their enterprise value is growing relatively in line with their market cap. Looking at the EV/EBITDA ratio, what we can see here is that they have actually always been kind of trading at a certain premium, which I think is something that you've come to expect with a brand like Ferrari, because of course they are very well known for their premium quality. They are very well known for their prestige, and that prestige very much comes with a premium. So they have been trading on average at 33 times earnings. So the company would have to run 33 consecutive years with their current year earnings for them to pay back the entirety of their company. Now, this is a very high number compared to all the companies that we've looked at previously, all the other European companies. And I think this really comes to show just the premium that people put on a brand like Ferrari. Looking at that debt level as well, like I mentioned, it's a bit high in certain times, but then again, they can cushion the debt because they have so much cash on hand. So I think this was like the most risky year, and if they wanted to, they can actually halve their debt, which makes this ratio come back down to 1.9 times. So I actually think when it comes to that debt, in the spreadsheet it looks a bit more scary than it actually is, because I do have some cash on hand here. Okay, looking at that cash flow from operations, it tells a very similar story to that earnings growth here, which is to say that that cash flow has grown from 400 million all the way to 1.3 billion in the last year. Now, the last year, again, it was a COVID high. People got stimulus checks. People just went around buying things. Now, to be fair, I don't think most of the people who got the stimulus checks also went ahead and bought a Ferrari. I think it's a little bit outside the price range there. But I do think that the increased consumer spending that was present during 2021 did lead to some increased sales for Ferrari, because we saw a lot of luxury brands actually having record sales. We saw it with Louis Vuitton as well. Because of the stimulus checks, people wanted the additional money that they just got given as an extra, and they spent it on luxury goods. And we see like a similar trend here with Ferrari as well. Now, to be fair, they do have a relatively high capital expenditure to put back into the business to make sure that they can run properly on a day-to-day basis. And these are all the expenses that come with running a business like this, like replacing machinery, replacing some of their facilities, maybe all those kind of costs which are needed to actually keep on running the business, giving a new brush of paint, new company cars. Everything that is required to run the business is included into the capital expenditure. So what we do see here is that their capital expenditure is not growing as fast as their cash flow from operations is, which again means that they are increasing their margins, which means they are more efficient in running their business. But the numbers are not significantly high when it comes to that. So I do think Ferrari has some future here where they can probably reduce the costs that are required to actually run their operation, because right now it's quite high, and the moment that they can actually minimize those expenses, I think Ferrari will be a lot more interesting to look at as an investor point of view. Free cash flow per share in 2014 they booked 136 million, which has risen all the way up to 546 million here in 2021, which was not quite a record year, but I think it's definitely a high year for them compared to their previous earnings. Overall, though, this gives us a 22% average increase year over year, which is very much what we like to see, a nice increase in cash flow there. Shares outstanding, we can see that it's been reducing a little bit, but not too much there to talk about. I think Ferrari, what they do is they pay out a little dividend of about 0.5% compared to their market price, and they also buy back some shares every now and again. Looking at free cash flow per share, now because the free cash flow has been growing and the shares have been decreasing a little bit, it's in line with free cash flow. It will probably be a little bit higher if we actually look at the additional decimals here, but by and large it's growing in line with the free cash flow itself. That brings us to the price per share. Now, this is quite a similar story that we saw with the market cap up here, which is to say that their share price has been going up a little faster than all the other shares in all the other stocks in the market. I think it's fair to say they had absolutely tremendous growth here, which I think, like, the moment that a company like Ferrari does an IPO, many people are probably interested in like just owning a premium brand, and not necessarily because they expect a high return from a company like this, but I think it's more so the, I don't know, even like the feeling of like, you know what, I own a part of the Ferrari brand, I own a part of that luxury car manufacturer. And whenever you see a beautiful Ferrari riding down the highway, you can get a feeling of, you know what, I helped manufacture that car, which is fair enough. And I think that's also why it trades at a premium, which is also very much what we see with their free cash flow yield. These percentages are incredibly low compared to any other European company that we've looked at recently. Now, at the IPO as well as the year after, they actually had like reasonable numbers, I think is fair to say, but after that they really came down drastically because they started trading at an absolute premium, even as low as 0.3%. This is a crazy valuation, it really is. We can see it here for the EV/EBITDA as well, 62 times. This was a crazy year, and I think it's definitely fair to say that they have been very, very overvalued in 2020. But we'll have a look at their projections now in the future. So let's have a look at how we can forecast this business. Now, what I always like to do is I like to give a conservative estimate for any company that I look at, and if that conservative estimate beats the stock market, that's when I'm going to be interested in owning the stock. And for Ferrari, what I'm doing here is for the very first year, I'm going to give them a negative growth because they had an absolute COVID high here in 2021 where they booked over 1 billion euros in earnings. Because of the economic headwinds that are coming our way in 2022, and because the stimulus time is kind of over at this point in time, I do expect the earnings to at least stay flat, if not come down here. So for this year, I'm going to give them a negative earnings growth. But afterwards, to be fair to them, because they have been growing by almost 16% year over year, I'm going to say, you know what, that's actually going to come down a little bit because I don't quite expect them to grow that much. Now, to be fair, we're just looking at the numbers. They have a lot of room to grow. But I think it's important to realize that they are a premium brand and they charge a little bit extra whenever they sell a car. So the moment that they start to ramp up production, I think the cost per unit is going to decrease, which is not something that Ferrari is very much into. So I don't think Ferrari is on the road to really expand drastically. I think they are happy to expand slowly, and that's why I'm also going to give them a 12% increase year over year, which I think is still a relatively nice number for them. So looking at that, we can also have to look at their enterprise value to EBITDA ratio, which historically has been at 33 times, which is ridiculous for any car manufacturer, frankly. Of course, Ferrari is a different breed because of their premium status, but still it's a very high number. Looking at their IPO years, they actually traded around 16 times, and in the past 3 years, it's been 45 times or higher. These are crazy numbers, and I actually expect the valuation to come down a little bit, as I think they should. But I want to be conservative, and I'm going to say it's going to be 20 times, which gets us back to like the 2018 numbers or prior to that. Because I think for the last 3 years, Ferrari has been incredibly overpriced, and I don't think that's a sustainable multiple given the growth that they've had previously. And even if we forecast that growth in the future, I really don't see that number. So I want to be conservative here, and I'm going to say 20 times, which is still quite high for a car manufacturer. Okay, I'm going to have to say that it's just not quite high for Ferrari. So looking at that, it gives me an enterprise value here of 59 billion, to which we subtract the cash, adds the debt, gives us a market cap of 58 billion, divided by the shares outstanding, gives me a stock price of 350 euros. So we're going to do the same thing here for their free cash flow. Now, just like with earnings, I expect their free cash flow to stay flat for the year 2022 because of them having to cool down from that COVID high. But afterwards, I'm going to give them a 15%. Historically, they've been doing 22%, which is to say that they've been increasing earnings, and on top of increasing their earnings, they've also reduced capital expenditure relative to their cash flow, which makes the free cash flow come even higher, and they're buying back some shares. So I feel pretty confident to say that our free cash flow is going to grow faster than the earnings is. I'm going to give them a 15% year over year growth here. Now, free cash flow yield, I'm going to give them 2%. Historically, they've been at 2.1% in all fairness. And I think for the last 3 years, even maybe 5 years, their yield has been very low. And I do expect that to come up a little bit as we get back to, I think it's fair to say realistic levels when it comes to valuation. I think Ferrari has been very overpriced for the last few years, so I'm going to say that comes up a little bit. I'm going to give them 2%, which I think is quite fair to them given their history, and also quite fair to them relative to their enterprise value model. But I want to be conservative, at least for one of the forecasts, so I'm going to give them 2% here, and that gives me a 451 euros share price 10 years in the future. So if I then combine these two estimates, which is the enterprise value multiple, where we were a bit more conservative when it comes to that multiple here, we gave them 20 times, even though historically on average they've been 33 times. I want to take a very conservative number here, and that gives us a share price of 315. Free cash flow model gives us 451. We split it down the middle because I'm not sure what's going to happen. Gives us a share price 10 years out of 383 euros and 37 cents, which is a stock price increase on just the stock market of 5.1% year over year. Now, on top of that, we also get the free cash flow because Ferrari does pay out a dividend to its investors, and it does buy back some shares, and that is the money that is not included into the share price on the stock market, but you do get as a bonus for holding the stock. So taking that into consideration, it gives me an internal rate of return of 7.7%. I always say on average the stock market returns about 10% a year. Ferrari, currently at the current price of 233 euros, does not outperform the stock market. Maybe that is because I gave it a relatively conservative estimate, and if you do actually believe that the multiple of 30 is more fair to Ferrari, then the IRR comes down to 9.8%, which is kind of in line with stock market expectations, maybe slightly below that. But this does not give you much cushion in case anything goes wrong and the valuation is going to come down, which I do expect it will. So for this forecast, I'm going to give them 20 times multiple here to be more conservative. And this number does not beat the stock market. But then again, if you're investing in Ferrari, maybe you're not quite expecting to beat the stock market. Maybe you just want to be a stock owner of a premium brand. That being said, let's have a look here, because I recently made a new little table here and I really want to show this off to you guys. So this is the share price right now, 233 euros, which gives us an IRR of 7.7%. But what happens if, for example, the share price comes down by 10% and goes to 209 euros? At that moment, I'm expecting an IRR of 8.8%. If it comes down 20% to 186, it comes down to 10.4, and I think this is the range where I'm going to be interested. The moment that Ferrari's share price is going to drop to around the 180, 190 euro range, that's when I'm going to be interested in owning this stock, because with the conservative estimates, I feel confident enough that I can make a decent return on Ferrari. But right now, with the share price sitting at 233, I do not feel confident doing that. Of course, the choice is up to you. And I'll leave it at that. So thank you very much for watching this video. Don't forget to like, subscribe, and all that good stuff. And I'll see you in the next one. Cheerio!